We're back. So I think last time we were at the bond market looking at LIBOR scandals, federal funds, and did a little bit of bonds. Yeah, I looked into municipal bonds. The tax equivalent, taxable yield. Yeah. So I'm trying to figure like if it's actually worth me like learning the ends of the like math of it right now. Like if I need to like dive into formulas. I don't think I want to yet, not because obviously that's more difficult than just reading. This isn't really challenging in terms of math, but just in terms of like what I expect to get out of my whole sessions. And what I'm trying to really get out of this is not a full grasp of the like a full detailed outline. I'm trying to not say too big of words. I have to like tone myself down because but I don't want to get too intricate. I really just want to introduce these financial concepts to myself so that when I see them later on when I'm studying for the CFA, they're not foreign to me and I'm seeing them for a second time, basically. So that's kind of how I've been thinking about it the past few days. So yeah, with that said, we're going to get back to it. Starting. Also, another thing, too. I saw a really good post, actually. I think it's important. Let me find it real quick, and then we'll get to it. Because I don't want to spend too much time talking. I saw this post on Reddit. It was like, this isn't an anti-productivity, go easier on yourself kind of post. If waking up early works better for you. Oh wait, no, this is what I posted. Oops. Where's like comments? Hold on. Saved. Upvoted. Oh, upvoted. There it is. Yeah, there you go. So on the CFA, I saw this today, the CFA subreddit. First off, don't waste time perfecting notes like you're writing a textbook. The curriculum's already massive. The goal is to understand, not transcribe. Focus on grasping the logic behind the concepts, especially in equity FRA, right? So this is important. And I thought it's just crazy that I saw it today because here I am, like editing this file to like make it all neat and stuff, and I don't want to spend too much time doing that. I want to spend more time learning and grasping the concept. So I'm still going to be typing like this for now until I find a better solution or a better way that I want to do it, because I still want to document and be able to read my notes. But I'm going to be doing it like this. I'm still going to be doing it like this, but I want to keep this sort of in mind. So, yeah. Let's get to it. What do I need to do right now? I need to set my like timer, I think. Yeah. Take this off too. Okay, let's go. Taxable versus tax exempt yields. Ratio of tax exempt to taxable yields has fluctuated around 7%. Bonds provide higher after tax yields. Equation 2.3 shows that the investor whose tax bracket federal plus local. So I know that the taxable yield, it is, you're trying to figure out how much benefit you are getting from a taxable investment versus a non-taxable investment. That's the point of the equation, which is this guy right here, equivalent taxable yield. So okay, let's get to this. Corporate bonds are the means by which private firms borrow money. Did I already put this in? Oh yeah. Borrow money directly from the public. These bonds are similar. So bonds are like IOUs. So the corporations issue the bonds to the public, and then people can take them out. They buy them. These bonds are similar in structure to treasury issues. They typically pay annual coupons over their lives and return at face value to the whole bondholder at maturity. They differ most importantly from treasury bonds in degree of risk. Default risk is a real consideration in the purchase of corporate bonds. Default risk, why? In Chapter 14 discusses the issue in considerable detail. For now, we distinguish only among secured bonds, which have specific collateral backing them, right? Like an MBS, right, obviously. Unsecured bonds called debentures, which have no collateral, and subordinate debentures, which have a lower priority claim to the firm's assets in the event of bankruptcy. Corporate bonds sometimes come with options attached. Callable bonds give the firm the option to repurchase the bond from the holder to speculate call price. Alright, so basically just options. Interesting. Mortgage-backed securities. Because of the explosion in mortgage-backed securities, almost anyone can invest in the portfolio of mortgage loans, and these securities have become a major component of the fixed income market. As described in Chapter 1, a mortgage-backed security is either an ownership claim in a pool of mortgages or an obligation that is secured by such a pool. Most pass-throughs have traditionally been comprised of conforming mortgages, which means that the loans must satisfy certain underwriting guidelines, standards for the creditworthiness of the borrower before they can be made purchased by Fannie Mae. Freddie Mac. In the years leading up to the financial crisis, however, a large amount of subprime mortgages, that is, risk loan financial borrowers. private label mortgage pass-throughs began to shrink rapidly. Agency pass-throughs shrank even more precipitously following an agreement for Freddie and Fannie to wind down purchases of mortgages for new pass-throughs. At the same time, existing pass-throughs shrank as healthy loans were paid off and the delinquent loans were removed from outstanding pools. The market expanded fivefold in the securitization of loans since 2007. After the financial crisis, it contracted considerably as the perceived risk of credit card and home equity loans skyrocketed as the asset-backed security market is still substantial. So let's do this quick. Try to move through this fast so I don't spend too much time. Common stocks, also known as equity securities, are equities, right? Each share of common stock entitles its owner to one vote on any matters of corporate governance that are put up to vote in the corporation's annual meeting into a share in the financial benefits of ownership. The corporation is controlled by a board of directors elected by the shareholders. The board, which meets only a few times each year, selects managers who actually run the corporation on a day-to-day basis, right? The managers are separate from the board, right? Managers have the authority to make most business decisions without the board's specific approval. The board's mandate is to oversee the management and ensure that it acts in the best interest of the shareholders. The members of the board are elected at an annual meeting. Shareholders who do not attend the annual meeting can vote by proxy, empowering another party to vote in their name. Management usually solicits the proxies of shareholders and normally gets a vast majority of these proxy votes. Thus, management usually has considerable discretion to run the firm as it sees fit without daily oversight of the equity holders who actually own the firm. two most important characteristics of common stock as an investment are its residual claim and limited liability. The heck? Corporation means that stockholders are the last in line of all those who have claim on the assets and income of the corporation. Okay, I get that. In the liquidation of the firm's assets, and the shareholders have a claim to what is left after all other claimants, such as the tax authorities, employers, suppliers, bondholders, and other creditors have been paid for. For a firm not in liquidation, shareholders have claimed part of the operating income left over after interest and taxes have been paid. EBITDA. So the most you can lose is your original investment, right? Limited liability. Residual claim and limited liability. Stock market listings. Buy 100 shares of IBM stock, on what are you entitled? Well, if you buy shares of IBM stock, you're entitled a portion of the proceeds that the stock gains over the time invested. What is the most money you can make on the investment over the next year? Infinite. It's an infinite amount of money that you can make. Technically, but I guess a more refined way to, that's there's no limit to how much money you can make. If you pay $180 per share, what is the most money you could lose over that year? 180. $2.8 represents key trading data, which 2.8, all right here. Key trading data for a small sample of stocks traded on the New York Stock Exchange. They might see on several markets which affects price of stocks. Consider the highlighted listing for General Electric. It provides a ticker symbol G. The closing price of the stock was $19.72. Alright, closed at $19.72. Its change was plus 13 cents from the previous trading day. About 45.3 million shares of GE traded on this day. Oh, does it say that? Yeah, 45 traded. Net change is a positive 13. Okay. The listing also provides the highest and lowest price in which GE traded in the last 52 weeks. 52-week high, 52-week low. Some volatility or spread, probably something like that, right? And the 0.68 value is the dividend column. In the dividend column means that the last quarterly dividend payment was 17 cents per share, which is consistent with annual dividend payments of 17 cents times 4, which equals to 68. Oh, okay. Got you. This corresponds to the annual dividend, i.e. annual dividend yield, i.e. annual dividend per dollar paid of the stock. 68 over 1972, 3.45%. That's the dividend yield. And yield is only part of the return on the stock investment. Ignores prospective capital gains. Losses. Low dividend firms presumably offer greater prospects for capital gains on investments that would not be willing to hold these stocks in their portfolios. PE ratio. The PE ratio, price earnings ratio. Tells us how much a stock. Oh, this is important. P ratio tells us how much stock purchasers must pay. How much stock purchasers must pay per dollar of earnings that the firm generates. P ratio. Price earnings ratio. How much does it cost to earn that much, basically? So, like for GE, the ratio of price to earnings is 16.1. The PE ratio also varies widely across firms, with a dividend yield and PE ratio not reported. The firms that have zero. Okay. We still have much to say about PE ratios in Chapter 18. Finally, we see GE stock price has increased by 10% since the beginning of the year. Preferred stock. Equity and debt, like bonds, it promises to pay its holder a fixed amount. Yeah. So preferred stock is similar to the infinite maturity bond. that is a perpetuity. It also resembles a bond in that it does not convey voting power regarding the management of the firm. Preferred stock is an equity investment. However, the firm retains discretion to make the dividend payments to the preferred stockholders. It has no contractual obligation to pay those dividends. Instead, preferred dividends are usually cumulative. That is, unpaid dividends accumulate and must be paid in full before any dividends may be paid to holders of common stock. In contrast, the firm does have a contractual obligation to make the interest payments on the debt. Failure to make these payments set off corporate bankruptcy proceedings. It's a lot going on there. Oh, excuse me. I sort of know this, but still a lot going on there. Let me check something real quick. Okay. Preferred stock also differs from bonds in terms of its tax treatment for the firms because preferred stock payments are treated as dividends rather than interest. Wait a minute, hold up. There's disadvantages somewhat also about the fact that corporations may exclude 70% of dividends received from domestic corporations in the computation of their taxable income. Preferred stocks therefore make desirable fixed income instruments for some corporations. Yeah. Even though preferred stock ranks after this is so I've been looking at this. I've been kind of exposed to this recently. I didn't understand like tax deductions, or like I didn't have like a grasp of it. I've heard the word, tax deductions and all of that stuff, and I knew it just meant that you get more money, but I didn't understand it, how it did. What it does is it lowers the amount of reported income that you have to, report to the IRS, i.e. how much the IRS chooses to tax your taxable income. And that's why it's a tax deduction, which may be very simple and common sense to most people. But silly me, I just didn't ever think about it, really. The more you know. Individual investors who cannot use the 70% tax exclusion generally find preferred stock yields unattractive relative to those on other available assets. Why are they dividing? Percent change in the portfolio's value. Why are they taking 5? Oh, because that's the difference. It's 125. It's the final value minus the initial value, which gives you the denominator, or the numerator, divided by the initial value. This gives us our percent change. Initial index value. Oh, okay, I get it. I get what they're doing. New value of the price would averages 30 plus 45 over 120 equals 62.5, the same as its value at the start of the price. The start of the year, therefore the rate of return is 0 rather than the negative 4% would return that we calculated in the absence of the split. The split reduces the relative weight of XYZ because its initial price is lower. Because the XYZ is the poor performing stock, the performance of the average is higher. In the same way the value is updated for stock splits, if one firm is dropped from the average and another firm with a different price is added, the divisor has to be updated to leave the average unchanged by the substitution. By 2013, the divisor for the Dow Jones Industrial Average had fallen to the value of about 0.1302. Wait, did it say none of them are on there? Many of the bluest of blue chips no longer exist. Texas Corp. Chrysler still exists, but it's trash. Radio Corp. American Sugar. Look at all these companies. Current Dow companies, right? Yeah, 3M, Radio Corp turned into Verizon. Or maybe, let me not say that. I get it. Well, which one stayed? Did Ford stay? General Motors? General Electric? Isn't General Motors still here? Oh, let me... General Electric, there it is. S&P. S&P 500 stock improvement in the Dow Jones two ways. First, it has more broadly based index of 500 firms. Second, is it a market value weighted index, which is pretty self-explanatory. It weighs the average of the top 500, puts it in a ticker. The 500 firms in the index. previous day. The percentage increase in the total value of the market index increase in index. The rate of return in the index equals the rate of return of the investor holding a portfolio of 500 firms in the index in proportion to the market values, except that the index does not reflect the cash dividends paid by those firms. Actually, most indexes today use a modified version of the market value weights rather than weighting by total market value, the weight by the market value of free float. That is, by the value of shares that are freely tradable among investors. For example, this procedure does not count shares held by founding families or governments. These shares are effectively not available for investors to purchase. The distinction is more important in Japan and Europe, where a higher fraction of shares are held in such non-traded portfolios. Okay, to illustrate how value-weighted indexes are computed, look again at Table 2.3. The final value of all outstanding stock in our two-sided universe was 690 million. The initial face value was 600 million, therefore the initial value of the market-weighted indexes. ETFs. Oh, we talk about ETFs more in chapter 4. Standard & Poor's also publishes 400 stock industrials index, a 20 stock transportation index, a 40 stock. Yeah, these are all the indexes. Actually, let me look for something real quick. God, I hate looking at my portfolio right now. It's cooked. My portfolio is cooked right now. You can hold on. I'm trying to find something, but I don't see it. Funds, is this it? There's a way you can go to model portfolio, yeah. Dividend yield holdings. Oh, and it gives you the risk profile, which is kind of cool. Volatility and all that, so that's kind of cool. Anyway, other U.S. market value indexes. National Association of Security Dealers publishes an index of more than 3,000 firms traded on the NASDAQ market. The ultimate U.S. equity index so far computed is the Wilshire. The Wilshire, huh? I'm just getting cooked. Portfolio is no longer is equally weighted. It is now more heavily invested in ABC. To reset the portfolio to equal weights, you need to rebalance, sell off some ABC stock and/or purchase more XYZ stock. Such rebalancing would be necessary to align with the return of your portfolio that was equally weighted index. Development in financial markets worldwide includes the construction of indexes for these markets. Among these are the Nikkei, Japan, FTSE, the DAX, TSX, TSX into a band. So is that what Drake said? Hold up. Yeah, Drake said, I'm gonna turn this TSX into a band soon. He's talking about that. He's talking about financial market. Interesting. Toronto Stock Exchange. Makes sense. Canada stocks lowers close of trade. Ooh. TSX is getting hit too. Just as stock market indexes provide guidance concerning the performance of the overall stock market, several bond market indicators measure the performance of various categories of bonds. The three most well-known groups of indexes are Merrill Lynch, Barclays, formerly the Lehman Brothers Index, and Salomon Smith Barney, now part of Citigroup. There's the components of the U.S. fixed income market. In 2012, the major problem with bond market indexes is that true rates of return on many bonds are difficult to compute because the infrequency with which the bonds trade makes reliable up-to-date prices difficult to obtain. So you can have like a bond index. You can have a derivative on a bond index. Options on. Yeah, that makes sense. That makes sense. Okay, so. The right but not the obligation to purchase an asset for a specified price called the exercise or strike price on or before a specified expiration date. Jeez. For example, July call option on IBM stock with the exercise price of 180 entitled. Titles is someone who's purchased IBM stock with price any notes include the expiration date of July. I actually know a bit about options already. So this isn't too bad. A put is exercised only if its holder can deliver an asset worth less than the exercise price in return for the exercise price. Talk about options here. I think I might stop here. Oh my gosh. Okay, I'm gonna read the news now. I think I'm gonna check out what's going on in the news today. It's a good place to stop. Trump tariffs wipe over $6 trillion on Wall Street. Epic two-day rut. The sell-off, man. Look at that. That's crazy. Fears of a recession mount. President Trump put up a wall between the U.S. economy and the rest of the world. The market tanked. And then the market tanked again. Message from Wall Street's epic two-day rout, which destroyed $6.6 trillion in market value. There is nowhere to hide from Trump's steep tariffs on goods imported from nearly every corner of the planet, manufacturers or retailers, exporters or importers, high-tech or low-tech. Big names in virtually every industry were hit. from Silicon Valley, behemoths like Apple and Meta platforms and aerospace manufacturers like Boeing. Yeah. It was all over the Dow Jones edition. Yeah, lost more than 300 points on the week. 3,000 points for the week. 30%, man. Or 7.9%. Dow Jones Industrial Average has lost more than. We just went over this. We just went over the Dow Jones. Explain. How does a loss of 3,000 points in the Dow Jones Industrial Average equate to a 7.9% dip? Percentage drop. The percentage drop is calculated by dividing the points drop by the starting value of the index. Oh, so if the Dow drops 3,000 points, and maybe I'll bring this over here, or maybe I'll do it like this. So if the Dow drops 3,000 points, and that represents a 7.9% drop, we can reverse engineer the starting value. Right? Okay, I get what they're saying. So the starting value was 3. Okay. I see. Dang, Big 7 lost 1.6 trillion. That's crazy. Money managers and bankers. Anxious lead up to what Trump touted as Liberation Day ended with dread. After a steep decline Thursday, the Dow fell another 2,200 points Friday as China retaliation against Trump tariffs raised the threat of protracted global trade war. Man, I gotta deal with this at work. All next week, I'm gonna be all in this, man. I have to deal with like these tariffs, like because I'm in an import business. Imports and exports, or imports. I'm in the imports division. Build out some stuff for our compliance team to sort of be able to capture all of these moving tariffs. Look at this. China said it would impose 34% on U.S. goods starting April 10. China played it wrong. They panicked, Trump said. I heard about this. I saw this. The jobs report said that they added 228,100 last month. Hold on, I kind of want to see this jobs report. Healthcare, social system, and transportation sector added jobs. But I wonder if this is just an overstatement. Like, I wonder if this is just like not real numbers though. We've seen it before. They've already done this many of times. This is from the Bureau of Labor Statistics. Labor Department right there. Unemployment ticked up to 4.2%. Layoffs were modest drag on payrolls. Federal government's employment declined by What's the U.S. GDP Haven't got a negative one yet. Okay. I think I'm about to cut it off here. And call it. Gold feature slid. Okay. I think that's all for me today. And pack it up. Peace.